It'll also depend on how that a lot of other stuff plays out too. Like we might have a crisis in T-bills, that there's not enough T-bills because they rehypothecated them a gazillion times over, and the housing market crash is starting to finally be accepted as real.
That's a good point. The 1 month yields. I remember you were talking about this the other day in Trading Floor. Persephone, was that the 1 month yields right as Powell started speaking just went totally crazy.
Oh no! When I woke up that morning, they were already up 6%. Not the percentage of the bond itself, but it had raised 6% overnight, and it was only the 1 month yields. All the other yields were just kind of normal change. And then about 5 minutes before he spoke, the 2 month yields jumped really fast too, or closer to the time he was to speak. And I said, okay, bond market thinks the next month is going to be really, really, really harsh. And I let everyone know. I was like, that's really weird. I have never seen yields jump 6% ever in this whole time I've been tracking them. And it was just the 1 month when I woke up that morning.
It actually opened up 8.5% higher from its previous day's close, according to this. Yeah. So at open, the opening candle opened up 8% higher, 7.9%, but close enough. That's a big jump in T-bills. These 1 month
That
T-bills.
was my sign.
Yeah. It was a good read. It was a really good read. And we've been discussing this more and more because you've been talking about bonds nonstop in the chat, which I appreciate a lot. I want to say that first of all. The pointing out the bond market has been really eye-opening because I've been watching this and I've been watching the HYG bond market and seeing the dump in the bonds that preceded Powell's speech. This would have told you everything you needed to know about what SPY was going to do that day. The high yield bonds were dumping while SPY was going up. And that was a divergence that should have alarmed everybody because high yield bonds, they are a leading indicator of the SPY. I'm now convinced. Like this was my crystal ball when I saw this that morning. And after the Powell speech at Jackson Hole, saw the market just start collapsing in on itself. This would have told me buy more puts and don't take a call option. Start selling calls and start buying puts. Because this collapse happened a full hour before Powell's speech even started. It was an incredible predication for what was going to happen at Jackson Hole.
I also think that it's probably more institutional and rich people that are utilizing the bond market, and retail isn't probably into bonds so much. So that's probably a good indicator of what larger money is doing.
Can I ask, 30-day treasury, is that the smallest amount of treasury besides the overnight rate that's almost like cash?
Come again?
Are you talking about the overnight repurchase agreements?
Well, the treasury bond that's a 30-day length, is there one between the overnight length and the 30-day, a time frame in between, or is that it?
You mean that investors can buy, like you and I?
I think that
like
the overnight repurchase is
repos.
Yeah, the repos, that's kind of separate. I'm trying to think of how to.
Yeah, and that's sort of what would be like close to being equivalent to cash. So I'm trying to see if the 30-day treasury is the next length of time after being like sort of close to cash as a hedge to keep a stable cash value.
I think the lowest bond that the Treasury offers is the 30, at least the public.
Yeah, there is no like 1 week treasury, 2 week treasury, is there?
No,
I don't think so.
I think there's a.
Okay,
yeah, I think it's just there's the 4 week, the 6 week, and the.
So it's a 30-day, and I thought it was 30 days.
I just call it 1 month, 2 month, 3 months, 6 months. That's it.
Yeah,
I keep it
that's
simple.
what it,
Yeah.
that's what it
I
is.
just keep
Yeah,
it
I was
simple.
just trying to find out if there was something in between, because I would say that the repo overnight rate is probably as close to cash for a hedge to keep the value like at a certain rate. And the next one up, I was just trying to see what the difference would be if there was one in between the 30-day that would be closer to cash.
You know what?
And the overnight, I think they can do it as long as they want between the two parties. It ends up being overnight, I guess, a lot of the time, but it can go on longer than that. And it's only specific banks that are allowed to trade those ones for sure.
Okay, thanks.
You know what I'm going to do as a special indicator going forward is I'm gonna set up this SPY over HYG indicator. So this is SPY divided by the high yield junk bonds, and when this is going down while SPY is sideways, if this is doing anything different than what SPY is doing, then you should pay attention to it. That's how I'm going to treat this. So I'm going to also put the SPY on this chart. And you'll see that there was a huge drop in this ahead of it, and this was pretty accurate at predicting the fall.
You mean a huge drop in the yields?
Yeah, the huge drop in the yields predicted the SPY's downturn. So HYG.
Should that be in the orange?
Yeah,
What's the orange?
the SPY is orange. The SPY is
Okay.
orange.
And the
HYG is the blue. Let me go ahead and
Okay.
take away the moving averages so as not to add to confusion.
It's like tracking somebody's footprints. Looking at it, scarily,
Yeah.
actually.
Yeah. Like
How
you
do
see
you work with
the
all those indicators? But we can get to that next. Go
yeah,
ahead.
but you can see the blue had a huge drop going in, and the SPY recovered, but HYG didn't. SPY recovered higher than the bonds did. So you see
Yeah.
how the blue line, it had this big dip, and then it recovered a little bit, but it hit a lower high and it got rejected here, and then it collapsed from there. The SPY made a full recovery and got above support, and this is what I think juked everybody out, because everyone was like, oh, SPY dropped as soon as Powell jumped onto the podium, but then it recovered immediately. So the market's pricing in a dovish speech, but that's not what happened. And the bonds actually collapsed first. So the high yield bonds started failing while the SPY was being bid up. That was the sign. It's a subtle difference, but you can clearly see a difference. The blue, high, low, lower, high, and rejection off of resistance.
Was that during the speech? Was that literally following?
That was
what
during
time
the speech. That was exactly during the speech. It started at 10 o'clock. It's 7 at my time. 10 o'clock
So
Eastern, 7 Pacific.
can I ask if the bonds sell off as a result of Powell's speech? Is that because people are expecting the rates to go up, so they want to be able to buy bonds at the higher rate now and get better yield, if that's what they're anticipating?
That's what investors anticipate, but the bond traders, they don't really care. They're trying to trade based on the price of the bonds, and they know that when the yields go up, they'll be able to get them for higher prices. The active pricing that's traded in the market is inversely related to the yield. So when the yields are going up from in the treasury bonds, then the prices, the price or the value of the bonds that are out in the market already go down. So they try to dump those bonds onto somebody else because they can get a better yield directly from the auctioneers that are selling bonds at the market yield rate. Does that make sense?
I think so.
Some comparison I drew is, you know how we trade with buying and selling stock options but don't exercise them?
Yes.
That's what they're doing with the bonds. They're not using them as originally intended, where you hold it until maturity. They're buying and selling for the difference of that price.
Arbitrage.
For the repo and reverse repo and how that connects into the treasury bills, there, with the lack of treasury bills, the major banks that are allowed to do the reverse repurchase agreements, they can acquire T-bills by by doing the reverse repurchase, is my understanding, like 1 year or less, and they trade these bills back and forth with the government, like buying and selling Pokemon cards, basically. And the T-bill itself is an asset, and they're getting, money from putting their money with the government at the same time. And everybody looks at it like it's the Fed taking money out of the system, but it's actually creating more money over time as the banks gain interest on the reverse repurchase and simultaneously can rehypothecate their T-bill that they now hold on to.
Yeah, and if I understood it right, it seemed like not only that, but they're making it rare by using it as an asset, like a safe asset. So they're making it more scarce so that they can rehypothecate what's left over that they're actually holding on to even more and over leverage.
So let me
I
see
think
if
a
I
good
can
way-
translate this for everybody that's going to be listening later on. With the concept of them rehypothecating T-bills is what makes this situation so dangerous. Is that it's the same concept as with naked shorting. Naked shorting is able to happen because the same share gets loaned out as a short to somebody who sells it to the market, and then the broker takes that same share and loans it out to somebody else, and then you have a daisy chain of this same single share that's been loaned out multiple times. The same thing is done by banks with T-bills and collateral, and the collateral acts as protection against their other assets and liabilities on their balance sheet. So what that means in simple terms is that you have somebody who has a T-bill that's worth, we'll say, $100, and they say, I'm using this T-bill to protect my $100 of debt that I have sold out into the market, so that if somebody else defaults on their debt, I can sell this T-bill and get that money back, and I can deliver it to my customers. But then what the bank does is that T-bill just sits there, so somebody else wants that T-bill for collateral. So they're like, I will loan you this T-bill if you promise to give it back. And that person does that. And then they have that T-bill as collateral on their balance sheet. But then they're like, well, this T-bill is not doing anything and the yield is so low that I don't really need it. So I'm going to loan this T-bill to somebody else. And then you have T-bills that have been loaned out 3, 4, 5 times. And this is actually documented by the Fed notes, where Federal Reserve Bank analysts have been watching collateralization in the market since like 2016. And they all observe this same behavior in the institutions, where they were loaning out T-bills repeatedly over a long period of time, creating these massive daisy chains of lent out collateral it basically created leverage out of thin air just because they loaned out the same T-bill to 5 different people. And as soon as one of them goes into default, then everybody after in the chain that needs to have that T-bill recalled gets screwed, because they lose their collateral and they have to go find it somewhere else, and it causes a scramble.
See, and I don't understand, because I thought that these T-bills were supposed to be this extra secured finance source of collateral that basically the ownership was owned, so that whoever had it owned it. And if it's being rehypothecated and over leveraged to so many different people, then you really don't have that security of the ownership anymore.
Well, that's exactly the
It's the
problem.
realization that we're just in free fall and nobody knew.
That's exactly what's happening. We have all of these major institutions and banks that I think are now coming to the realization that they have all of this rehypothecated collateral that isn't good collateral anymore, and we're going to have that crisis. And the fact that T-bills have been at historically low prices, like going all the way back to going back since the COVID pandemic, where the yields fell off of a cliff and then went sideways all of this time, this was because of a shortage. All of this indicates a massive shortage of T-bills. Everybody wanted them, so they were buying them up anywhere they could get them.
I think that's the opposite, though. If they're buying them up, then that's when the yields will plummet and the prices of the bonds themselves will skyrocket.
Well, yeah, I'm sorry. The prices they were willing to pay any price, but what I mean is that they were desperate to get their hands on the T-bills because they wanted that collateral on their balance sheet to offset all of the cash deposits that were going into the banks. One of the highlights of the pandemic was that everybody, including corporations, was just depositing all their cash into the bank and turtling up. And this caused the banks to get really flush with cash really quickly, which actually is a liability on their balance sheet. And I'm speaking to everybody in the room because Persephone, I know we've talked about this before, but the concept of cash being a liability for the banks causes them to want to get rid of that cash. So where do they put it? Well, they deposit it at the Fed, and then they get a T-bill in response. They get that T-bill back, and that gives them collateral. And while they're holding onto that T-bill, they can just issue it out somewhere else or do something else with it. And that includes fun things like using it for crypto collateral, for leveraged crypto asset exchange.
Where it gets a little funny at, though, is when the Fed gives them a discount rate, so they get the T-bill at a discounted rate.
Right.
And then they turn around and repackage it. So if I were to explain it to Steve Carell from The Office, I would explain it like this. I really like pizza. Here's $20.
Maybe you ought to do Fed share.
Right. So then I take a pizza. I take 8 different slices. I put it in 8 different boxes. And I tell you it's worth $20, and I give that to you, so that when it all goes tits up, now I'm responsible for this pizza that I've sold to 8 different people that's not worth $160. That's where it gets funny. That's what you were saying earlier.
Yeah, I have a link to my source of that Fed paper. It's also in my paper as well.
Yeah, that was an enlightening read. Seeing the collateral chain and the opportunity for complete societal collapse of the financial system because of overuse of T-bills as collateral, and the fact that they've been rehypothecated like 5 times into the market, honestly scares the ever-living shit out of me. I can't wait. I can't wait to see what happens when all of this goes tits up. It's going to blow up in their faces, and it's probably happening right now, because this is just telling me that there's a bunch of T-bills out in the market that, honestly, I don't know if they're ever going to be able to cover all of it, because this $2.2 trillion of T-bills that have been issued out into the market in reverse repurchase agreements, where all of this $2.27 trillion of cash is just sitting at the Fed, quote, funding operations. Honestly, it's just sitting there not doing anything, except earning the banks more interest, and on top of the banks getting yields for the treasuries while they loan them out and issue collateral 5 times over to everybody that asks for it. I'm surprised that things haven't completely collapsed with crypto losing their what do they refer to it as, the pin?
Probably just hasn't been enough time yet. Bankruptcy and stuff takes a while.
Yeah. And they're going to hide it, of course. They're going to shuffle numbers around, and eventually somebody's not going to get paid, and they're going to start asking questions, and then they issue an investigation, and then 30 days goes by, and then somebody finds out, oh yeah, the bank's actually insolvent, and then somebody in the around the corner of the hall says, what, insolvent? And then everybody in the hall hears insolvent, and then, well, the word's out, and then panic ensues. So that's what I'm waiting for, is for one person outside of the need to know circle to finally hear the word insolvent and then mass panic, just like The Simpsons. That's what I'm waiting for, is for Bart Simpson to just whisper in the bank, what, insolvent? And then everybody just freaks out and then starts making a run on Bank of America. It's a bit cartoonish, but not too far off from the potential reality that we're facing in front of us.
For anyone else wondering how this can happen with the T-bills too, they are serialized, but you don't have to return the same serialized T-bill when you do the repurchase or reverse repurchase agreement. You just have to return like a similar asset.
And there you go. There's where the opportunity for fraud comes in. And why do naked shorts happen? Because we don't serialize the digital shares. Case closed.